My name is Jessica Lumi Oluwagbemi, and I am the founder of the Financial Literate, which was born from the passion to see that youths, teens, and adults are financially literate. I believe those financial terms are not as complex as you think they are, and you can understand and apply them to your finances. Yes, you can build wealth with the right plan in place, the right money personality, consistency, and the right lessons at each step of the way. So I bring to you the Financial Literate series, a video series that would break down the seemingly financial complex terms and give you the right lessons at every step of your journey to financial independence and freedom. So, let's get started. Welcome to today's episode of this series, and in today's episode I'm going to be talking about that topic we always want to learn more about, and that is investment. Now I know investment is not as simple as nursery rhymes, but then it is not as complicated as a lot of people think it is. So I'm going to simplify investments in the best way I can, and I've been able to divide investment into 3 stages, which I call the 1, 2, 3 of investment: the stage 1, the stage 2, and the stage 3. In today's episode I'm going to be discussing the stage 1 and the stage 2 of investment, and in the next episode I'm going to be discussing the stage 3 of investment. Now I hope you know that investment is not just I have a particular amount of money and this is an investment option, let me just take it. No, investment is beyond that. So the stage 1 of investment is invest with a goal in mind, a goal-based investment. You should invest with a goal in mind. Now let me give you an analogy. I work out daily because I want to keep fit. That's all. I don't want to shed any more weight. I just want to keep fit. On the other hand, my sister works out daily because she wants to shed some weight. Now, because our goals for exercising are different, we have different workout routines. I cannot use my sister's routine because it will not fit my goal, and she can't use my routine because it will not fit our goal. And that is the same thing for investment. When you invest, don't invest because your friend is investing in this particular option. The fact that the investment is good for your friend does not mean the investment is good for you. Rather, you two may have different investment options. Now, what are the investment goals? Your investment goals are why you are investing. What is the end reason for your investment? Why are you investing? Are you trying to plan for retirement, or you are investing to accumulate capital for a business, or you want to generate passive income, or you want to generate another source of income? You are looking for another source of income, or whatever the reason for investment. Have a goal for investing in mind. Then you can be able to look at the best options that suit your goals. But at least first start with a goal. Why are you investing? Don't just invest because I'm just investing. Then anything happens, you can okay, give me my money back. I don't want to invest again. Why? Because you never had a goal for investment in mind. So now invest with a goal, list out your goals, and you can now start looking for investment options that suit your goal. Another thing is that when you list out your investment goals, you can know the time horizon of your goals. We have short-term investment options, medium-term investment options, and long-term investment options. Now, if your goal is short-term, you need your money maybe within a year or less than a year or maybe a year, you can go for money market instruments, treasury bills, money market mutual funds, because they can suit your investment goal. And if you want to invest long term, you can look at the stock market, the bond market, but at least you know your investment goal and you can determine the time horizon with your goal. That is the stage 1 of investment. The second stage is the relationship between risk and return. You should know that when you are investing, you should understand the relationship between risk and return. Risk is the possibility that you can lose either a part or full amount of your returns or even the capital sum invested. Now, returns is the interest you earn on your investment, that which you earn on investing. So now there's this rule that says that the higher the expected return, the higher the risk, and the lower the expected returns, the lower the risk. So you cannot say I actually want to invest in an option that will give me super returns, and at the same time my money is going to be safe. It doesn't work that way. You have to choose one. Either you want your money to be safe and then lower returns, or you want your money to give you higher returns, but then you are prepared to take higher risks. So you should actually know the appropriate amount of risks you should get exposed to. It is very, very important that you know the appropriate amount of risks you should get exposed to. You should know your risk tolerance level. And to know your risk tolerance level, there are two categories you can use. You can use your ability to take risks and your willingness to take risks. So your willingness to take risks is it focuses on psychological factors such as your investment experience, your investment knowledge, your attitude towards risks. Some people are risk takers naturally, they love taking up risks. Your ability to take risks focuses on situational factors such as your time horizon, your investment goal. Now, given this investment goal, taking a look at your investment goal, is this something that you can afford to lose a part of the money? You can take up some risks. Taking a look at your investment goal, time horizon, if it is short term, then keep your money in money market instruments or short-term instruments so that you can, with little risks, because there's not enough time to recoup the losses that can come in higher risk related options. Also, your assets backup. Do you already have appropriate amounts of assets backed up, or you just take the entirety of your money and say, I am going to the stock market and I want to put all my earned money into the stock market, and you have nothing to fall back on? So your assets backup is also important. Your age, because the older you get, the lower the risk you should take. Then the responsibility, your level of responsibility. Do you have so much responsibility on you and you know that, okay, I can't afford to lose so much money? So now in any given scenario, you should pick the lower one in your ability to take risks or your willingness to take risks. So if your willingness to take risks is lower than your ability to take risks, go for your willingness to take risks. That's the level of risks you should take. And if your ability to take risks is lower than your willingness to take risks, you should go for your ability to take risks. That's the level of your ability to take risks. That is how you know the appropriate amount of risks you should get exposed to. So in the next episode, I'll be talking about the investment options that we have available. I'm sure a lot of us want to know that. So I'll be talking about the investment options. So just stay tuned, and this time next week, join me on another episode as I explain more investment, or I explain more on investment, telling us the investment options available to us. Okay, so if you've not subscribed to this channel, do well to subscribe so that you can get our weekly notifications of our posts, and then you can also join our community for free, or follow me on Instagram to get weekly finance tips. You can check out the description box for more details.